Let's think about a time when you gave generously to a cause that you really care about. How did it feel? I know for many of us, it's a very important part of our lives. It is for my wife and I. And it gives us an opportunity to help others, to live out our faith, and to get that feeling that we get when we can be generous. Tonight, we're going to talk about charitable giving and then some year end tax strategies. We're going to also talk about the impact of the Secure Act that passed at the end of last year and the CARES Act, which was the coronavirus stimulus package that passed earlier this year. Now, my name is Joe Dewey. I'm with Prairie View Wealth Partners, and I'm one of the advisors along with Tim Reagan, the founder, and I'm also the webinar workshop speaker. So I'm here with you this evening to share some ideas around these strategies and some topics around giving that you may have already know that might be helpful. Because we're adding some of that additional information regarding the CARES Act and the Secure Act, this presentation is normally a little bit shorter. We're going to expand it a little bit to be able to cover those additional topics. And so tonight, as we begin, I want you to also know that if you have questions, please feel free to use the Q&A button. If you hover towards the bottom of the screen, there's a Q&A section. You click on that button and you can type in your questions. And so I am not having a monitor tonight, somebody monitoring the Q&A. So I may have to just check it from time to time, and certainly before we're done, we'll answer any questions that come in there. We had some nice questions at the afternoon session, and please feel free to be sure and ask your questions. If you're familiar with Prairie View Wealth Partners, we're a part of the Thrivent Advisor Network, and our office is located in the south suburbs of Orland Park, Illinois, south of Chicago, and we also have satellite office in Bloomingdale. And we are committed to helping people live their legacy with confidence, to give you the tools, the planning, and the training that can help you achieve your goals. And one of those goals that many of our clients have, and you may have, is along the lines of giving. How can we best give to help the charities and the people that we care about, but also to do it the most efficiently as possible, and if there are the possibility for tax savings as well. So I am going to share a presentation on this topic, again, on the charitable giving and some tax strategies. So why are we here? Well, in other words, we have to realize that we don't need to be rich, old, or dead to make a memorable impact. We're here to look at giving. And the purpose of the webinar is to offer ideas and options that align with your values so that you can give in ways that make sense to you. We'll also touch on how having a strategy in place can help make planned giving easy and efficient. Also, we're going to go through, as I mentioned, the updates on the tax implications from the various new acts that have been passed over the last year. We tend to talk a lot about generosity, but really, what does it mean? It's the simplest form. Generosity can be defined as the habit of giving without expecting anything in return. Now, there are different ways to be generous and different reasons for being generous. Those different ways could include sharing your time and your talents. In other words, volunteering. When you're stuffing envelopes for your favorite nonprofit's fundraising campaign, or teaching business basics to school-age kids via Junior Achievement, your time and talents are incredibly valuable gifts that can make a difference. Also, sharing your treasures. We're talking about your financial assets, whether it's writing a check, opening your pocketbook, or one of the many ways you can give as a part of an overall financial strategy. And we're going to talk about some of those strategies this evening. You can set up these gifts to take effect now or later on your death, depending on your situation. I'd like to take a moment and share a poll just so I can get an indication of how people feel about generosity. And so this should pop up on your screen. And what types of generosity strategies do you use? And multiple answers are okay, whether it's spontaneous giving, just giving out of your heart right in the moment, whether it's intentional or regular giving, like giving to your church or regular giving to a charity and tithing, strategic or planned giving through your will or trust beneficiaries and so forth. And maybe you have other strategies. So you can just take a moment and click on those that you're using currently. It'll give us an idea of kind of where we're at. Looks like most everybody's had an opportunity to click on this. So we're going to stop that for the moment and just give you an idea. It looks like 100% of the respondents are giving regularly, and most of those, 67%, have done some planning around strategic or planned giving. That's terrific. I'm so glad to see that and know that the people with us tonight are certainly interested in giving back. And so, when we think about our giving, when we think about generosity, why are you generous? For some people, possibly many of us, being generous is a way to share our blessings with others, a way to put our faith into action. Others give to express their values and maybe to serve as role models, say to your kids or grandkids via these gestures of generosity. Let's admit it, giving makes us feel good and could also provide income tax benefits based upon when and how we give. So we want to take a look at thinking about our giving strategies or our plan. When we talk about giving, there are three primary ways to do so, and they always, in all these ways, can be linked to your values. The three primary ways, as I had in that poll, are spontaneous, intentional, and strategic or planned. Now, spontaneous giving is giving to a cause when time is of the essence, maybe for a disaster relief, or at holiday time, the Red Kettles for Salvation Army. Maybe it's American Cancer Society's Relay for Life, or a local student that's doing a fundraiser for their school. Spontaneous giving comes from the heart and typically doesn't involve a lot of preparation. Either you give or you don't. Usually have some connection to the person making the request, so you feel like giving something, even if it's not a lot. Regardless of how much you personally can give, it all adds up and helps to make a difference. It's like my former neighbors that had an 8 and 10-year-old. And of course, every time that their school had a fundraiser, we got to help out. And that's all right. That was fun. So to recap, spontaneous giving tends to be driven by current events, maybe inspired by emotions or personal connections. It's rarely planned. It's often just off the cuff, and requests can come out of the blue and land in your lap. You give because it's often a face-to-face encounter and somebody asking you nicely to give, and likely somebody you're acquainted with. Think about how much you spontaneously give over a year. Think about those pizzas for the hockey team, or the Girl Scout cookies, or that spare change I mentioned in the Red Kettle. It does add up, and so it's good sometimes to think about how much does it add up, and is that spontaneous giving reflecting my values? Does it benefit the organizations that I want it to? And have you considered building these unanticipated expenditures into your planned budgeting? Building spontaneous giving opportunities into your planned budget. Now, I know that sounds a little like an oxymoron, that we're going to plan for spontaneity, but what it does is gives us permission to say no to unplanned solicitations, maybe something that you're not particularly interested in, especially if you're also giving in other ways. And we'll get to that shortly. Now, there also may be possible income tax benefits as long as it's a charitable donation to an IRS qualified charity, can be tax deductible, but those donors must itemize deduction to receive that charitable income tax deduction. So now then let's talk about intentional giving. Intentional giving includes donations you make on a regular basis, sometimes at intervals throughout the year, sometimes annually. Let's think about some of the things that you might give to intentionally to your church, whether it's weekly, monthly, annually. I do it every week online, so I don't even have to well, because we're not gathering in physically in the church right now. It definitely is a good way to do it. At work, if you're still working, they might have an employee giving campaign or a payroll deduction. To a nonprofit that you volunteer at, or to your college or alumni association. Maybe it's your kids or your grandkids' schools, or to your favorite charities over the holidays, especially at Christmas time. One side note, it's great to volunteer for charities at Christmas time, maybe at Easter, but think about them the rest of the year too, because oftentimes that's when they might need the most help. You give because you have a connection and because it feels like it's the right thing to do. And maybe it's a family tradition that in your family you always give to a particular organization or a church or whatever it may be. These donations tend to be more significant, and they can include gifts of stock as well as cash, maybe through a payroll deduction plan or an automatic payment through your online giving. These donations may be tax deductible. Now, while Prairie View Wealth Partners and Thrivent does not provide legal or tax advice, we can partner with you and your tax professional or attorney, and to make sure that those donations should be part of your overall budget, and critically, about your financial plan. You notice we're financial planners and talking about charitable giving. A lot of times in the world that doesn't happen, but it's very important as a part of our client family. Then the third type of giving is referred to as planned giving. Now, this is much more significant gift typically. And this is sort of at that top of that pyramid that's there, that starts with your overall life financial plan of making sure you have protection and accumulation, a distribution plan for once you decide to retire, but then leaving a legacy with confidence. And so these planned gifts can be part of a comprehensive financial plan or a formal estate plan or a strategy. And they're designed to help the people and organizations that matter to you the most, to your family, church, charities, and causes. And by providing them a more significant gift while you're living or after you pass away, can have a great impact on the organization. Now, unlike unplanned or spontaneous and intentional gifts, which tend to consist mostly of cash contribution, strategic or planned gifts tend to consist of assets like stocks, real estate, life insurance, annuities, investments, or perhaps a bequest and a will. They provide the opportunity to leave a legacy while living and may receive potential income tax benefits. Planned gifts don't have to be large to make a difference. Remember, all giving counts. Now, right now, you might be thinking that planned giving is only for the wealthy or only for those on their deathbeds. Well, that's not true. You might also think that leaving a large gift to a nonprofit will reduce the amount of money you can leave to your kids or grandkids, but this isn't always the case. And possibly you may believe that once a long-term strategic plan is in place, it can't be changed, but that's not necessarily true either. There are several options that can give you flexibility if your plans change down the road. So when planned giving is incorporated or included as a part of a formal estate or financial strategy, you have much greater freedom. You can give more, and in some cases, actually add to your income. You can give an asset other than cash. If an organization is near and dear to your heart and you want to help them sustain it, planned giving can help you achieve your goals. And if you wish, you can even see the fruits of your giving while you're still alive. We'll illustrate that shortly. So, what does a giving strategy consist of? Well, it depends. Everybody's situation is different. Planned giving is typically integrated into an overall financial strategy. Planned giving could consist of the gifts of cash, stock, or qualified IRA distributions to a charitable organization. Depending on your income tax situation, you may be able to claim a deduction. Charitable deductions to an IRS qualified charity, 501c3, are tax deductible. The only thing is, donors must be able to claim or itemize their deductions to receive that charitable income tax deduction. This year, and over the last couple of years, with the change in the tax laws and the increase in that standard deduction, almost 90% of the people actually take the standard deduction and don't itemize anymore. But this year, there might be a possible exception. We're going to talk about that before we finish, about how we can actually maybe have some tax deduction on top of our standard deduction this year. But you'll want to check with your tax advisor for which benefits may be available to your situation and in where you live. Now, it can consist of beneficiary proceeds from life insurance or annuity contracts or retirement assets at your death. You can also name a charity as the owner and beneficiary of a life insurance contract. Now, you'd give the charity an annual gift of cash to pay the premiums, and then that'll keep the contract in force. And your gift of the premium may be tax deductible. But then when you pass, the charity will receive the death benefit, and that, of course, is free of any federal income taxes. With charitable gift annuities, which are a little bit different, you give money, stocks, or mutual funds to a charity, generally a foundation, and in turn receive income payments for life. These payments can begin immediately or be deferred to a future date and provide a great way to supplement your retirement income. When you pass on, the remainder of the charitable gift annuity passes to the charity you designate as the beneficiary. Now, a charitable remainder trust is very similar in some ways to a charitable gift annuity, where you give money or property to the charitable trust. Then you or someone you designate, maybe a family member, can receive lifetime income. Oftentimes, families with special needs child might set these type of charitable remainder trust up for the child after they're gone. Donor advised funds allow you to give one or multiple charities, uh, giving them assets. First, you'd give the assets to the charitable fund and establish the donor advised fund through the foundation. You may receive a tax deduction for your gifts, and you can make grants from the fund to your favorite charities at the times of your choosing. You can involve your family in deciding where to direct your giving, and or you can remain anonymous. It's kind of your wish. There's a story that's from Thrivent that I really enjoy. So these are Thrivent, actual Thrivent members. And I'm not going to use their names, but it's grandparents, and they wanted to teach their children, their grandchildren about being generous. And so what they did is they took a good sum of money, set up a donor advised fund. I think it was $50,000, and with that, they could use the growth in that fund each year for their donor advised giving. So what they did, back when you could gather in person at Thanksgiving, they told the families, they gathered the family together and the children, the grandchildren, and said, we have good and bad news. This year, the bad news is there are not going to be any gifts to open under the tree from us. The good news is you're going to each get $500 to donate to one of the causes that is in this booklet. Maybe it's a Heifer International or ELCA Good Gifts or one of those types of things. And then at Christmas, you're going to report back of where you gave the money. And so they would set out to do that. And in this case, it was very charming. There was one young child that said, oh, I got so excited. I donated the money to buy a new goat for a family in need across the seas. His younger brother, to one up, bought water purification and some pills to purify water and so forth. They said, I took the $500 that Grandma and Grandpa gave me. I broke into my piggy bank and got another 25 so that I could complete that full gift. So there are many ways that families can use these types of giving strategies to benefit the charity and to benefit their families. So another way to include is in the will or your trust. You can include a charitable gift provision right in that will or trust document. So when you die, your estate may receive a charitable tax deduction for the value of the bequest. Remember that gifts needn't be substantial to make a difference. All gifts are appreciated. So we're going to look at a couple of examples of people that have established legacy gift strategies. And of course, we've changed their names for privacy reasons, but the results these people experienced may differ from your situation or might spark an interest that you might have as well. So first, we're going to meet Ronald and Jessica. The R and the J are actually initials from their real first names. They're friends of mine. But Ronald and Jessica, they're in their early 60s. They're very involved at their church, and they really want to fulfill a commitment they made to their church's building campaign. It was pretty significant. It was a 3-year campaign, and they committed $50,000 to the building extension that went on my former church. Part of the reason it was so extensive is Jessica was the chairperson of the committee for the building fund. But if we look at a solution of how could they do that? Well, their solution, as we went through their financial plan and analyzed all their assets, the solution was to donate some appreciated stock. So they'd made the $50,000 pledge to the campaign. They hadn't put anything towards it yet, and it was coming up to the end of the 3 years. Well, that stock that they'd held had appreciated for more than $50,000. So they donated the stock to the church. They took the charitable gift tax deduction, and then the church sold the stock to meet their pledge. So you can see they were able to accomplish their goals, make it beneficial to the church and the charity in this case, and then to be able to benefit in the way of some tax deduction as well. Let's meet Amanda and Hank. So this couple in their early 30s with grown children, they own farmland, want to be able to pass that along, and they're very charitable minded. The key things is they wanted also to have a secure retirement, to be able to provide for their children, and to give to their church and favorite charities. So they really wanted to be sure that they had their plan in place. So in this case, especially because of the large asset of the farmland, they decided to establish a charitable trust and a donor advised fund from their favorite foundation. So these are actual clients of Prairie View Wealth Partners. And as part of their process, we connected them with In Faith Foundation, which is a foundation that was originally helped funded by Thrivent and still work closely to them together with them today. And so they were able to establish that charitable trust and then the donor advised fund, and they receive quarterly payments from the trust. So that helps with their income. And their children receive income tax free inheritance once they pass. The charities are going to receive ongoing donations from the trust remainder upon their death. So the growth in that trust each year will get donated to their charities. And of course, that giving is going to go on and establishing and leaving their legacy. So why would you act now? Why would that be a motivation to get started today? Well, the motivation for some people is actually to live their legacy. In other words, to see their generosity at work. Now, this is a bit of an extreme example, but kind of like Bill and Melinda Gates or Warren Buffett, probably on a smaller scale. But depending on the financial vehicles used and how they're set up, they could benefit you too. By having the ability to receive an income now or cover future income needs, by helping ensure that your children or grandchildren can receive benefits as part of your legacy or your family's giving traditions, by helping to sustain the future of nonprofits that matter to you most, perhaps giving more than you ever thought possible, and in some cases, maybe reducing income taxes. One of my favorite things to do. Have you identified the need to develop a plan or look at your legacy strategy to help make sure that your needs and interests are addressed? You can unleash your generosity, and you can, as we encourage our clients, live your legacy with confidence. One of the things you should do is assemble the right tools and the right team. Remember that this strategy may need to involve your financial professional, your tax professional, legal professional, and your family. In fact, I'm in the midst right now of working with my wife's family, with her parents, to go through with the family and take an overview, a kind of a review for the family of the financial retirement situation, but also the legacy that her parents are intending to leave. So you need to be willing to work together with your team to achieve those goals. Planned giving provides each of us with a meaningful way to express our generosity, our beliefs, and our values. Working with a reputable foundation for charitable giving can be a great way to do that. One of the, again, I brought up before, In Faith Community Foundation. They can help make your giving even bigger and wiser and make it last longer. You can learn about them at infaithfound.org. And if you need that contact information, we actually can arrange that because at Prairie View, we do partner with them. Through such a foundation, donors can make charitable gifts to support their favorite charities and causes. We can work together with in this case, In Faith or your foundation, to deliver charitable giving solutions to our clients. We kind of view it as a blending of In Faith's mission to spread joy and Prairie View Wealth Partners' work to help people live more confident and more generous lives. So charitable giving foundations can make it bigger and wiser because they can offer donor advised funds, provide a vehicle for centralized giving, investing for youth. They can for growth. They can provide the charitable gift annuities and the charitable trusts. Also can help uncover potential income tax benefits, which could mean larger gifts that you could give. And giving can be incorporated into your overall financial strategy. Of course, very important for us and for our clients is to include all of this into the financial plan. But you want to be sure and choose this foundation that has earned some of the top ratings for sound fiscal management, that they really are transparent. And you can use ratings agencies like GuideStar and Charity Navigator to help look that up. Certainly, you can check out In Faith, and they look really well on those. So that's kind of in summary is the ways that we can look at what does charitable giving mean, what is generosity, and how can we do it. Now, to blend that together with some of the potential tax strategies and the changes in the laws, we want to take a look at those laws that acts that were passed in the past year that have an impact on our giving. And one of those is the Secure Act. Have you ever heard of the Secure Act? Well, late last year in 2019, Congress passed the Setting Every Community Up for Retirement Enhancement, Secure Act, and it became law. The Secure Act represents the most sweeping set of changes to retirement legislation in more than a decade. And I just realized as I sort of switch um, topics here, I just want to take a moment and check the Q&A. We don't have any right now, but again, feel free to use that Q&A button for any questions that you might have. So we want to take a quick review of some of the key points in this law, how it can affect you and your investing and your retirement planning. On the plus side, the Secure Act included several provisions designed to benefit American workers and retirees. People who choose to work beyond the traditional retirement age will still be able to contribute to traditional IRAs even beyond the age 70 and a half. The previous laws prevented that from happening. And retirees no longer have to take required minimum distributions from traditional IRAs and retirement plans the year they turn 70 and a half, or actually by April 1st the following year. The new law generally requires those RMDs, those required minimum distributions, to begin when you turn 72, actually no later than April 1st, the year following the year you turn 72. So that's a big change. And also, if you have family members, this and yourself even, this can impact the family and medical benefits that were part of the Secure Act. So there's new family and medical benefits. For example, you can now take penalty-free withdrawals, early withdrawals, for up to $5,000 for the birth or adoption of a child. Now, that may not be your situation, but maybe one of your children, that could impact them. It's good to be able to pass that on to them. If you're a taxpayer with high medical bills, you will be able to deduct unreimbursed medical expenses that exceed 7.5% of your adjusted gross income. That was for last year and for 2020. So if you have your adjusted gross income, you have medical expenses, unreimbursed ones, more than 7.5% of that AGI, then you'll be able to deduct that. Of course, if you itemize your expenses. That threshold actually in 2021 returns to 10%. So instead of 7.5% of your adjusted gross income, those expenses need to be higher than 10% of your adjusted gross income. So that makes a big difference. If you or a family member have student loans, 529 plans are now allowed. If there's assets still within those 529 plans, they can be used to repay student loans up to $10,000 lifetime maximum. Or it can also, this is a nice change, it can go towards the cost associated with the registered apprenticeships. So it's not just college, but the trades as well. Now, have you heard of qualified charitable distributions? You hear us often talk about QCDs. Well, after the Secure Act, the QCD has a few differences. In the past, that qualified charitable distribution, in other words, taking a qualified IRA, sending a portion of a contribution directly to a charity and not taking possession of it, then you don't have to pay taxes on it and the charity can benefit. It's called a QCD. So the QCD rules indicated that if you were over 70 and a half years old, you could make that direct distribution to the charitable organization from your IRA. This distribution also would apply towards your RMD for the year. So even though it would normally have been taxable, if it goes directly to the charity through a QCD, then that RMD can be satisfied. So it is a great way to, again, satisfy the RMD that normally would be taxable and to benefit your charity. By making this direct contribution, again, you would normally have to, if you didn't make the direct contribution, you'd have to claim it on your tax return. Now, even though the Secure Act came along and changed the RMD age to 72, you're still allowed to make that QCD when you reach 70 and a half. So now, even though you won't be subject to RMDs until 72, you still can take advantage of using a QCD once you hit 70 and a half. Now, a big change, were you ever a recipient of an IRA or retirement plan assets as an inheritance? Remember, you could spread that taxable distribution out probably over your lifetime after the death of the IRA owner. And that was referred to as the stretch IRA rule. Under the Secure Act, that rule is eliminated. This means non-spouse beneficiaries who inherit an IRA cannot continue to spread those distributions over their lifetime. And therefore, the taxes that go along with it aren't spread out either. So that's not spread out over their lifetime. They now generally have 10 years to liquidate the account. So if you have a sizable IRA and you pass that on to, say, your kids, let's say they inherit $200,000 each in an IRA. Well, that's going to be an extra $20,000 of income a year that they're going to potentially be faced as a tax consequence. There are some exceptions. A spouse can inherit an IRA, and of course, then they just take it over. Also, a disabled or chronically ill individual can have longer than the 10 years. Someone that's less than 10 years younger than the account owner can also stretch it out. And the minor child of a retirement account owner, until they reach age, can stretch those payments or those distributions. So those situations, and you can ask us for specifics about those, but those are the ones that you can continue to sort of stretch it out. Everybody else, it has to be liquidated within 10 years. Now, I'm going to ask a weird question, but have you ever seen or heard of a black swan? We're going to switch gears here and start talking about the COVID-19 stimulus package that passed called the CARES Act. Now, the reason I ask if you've ever seen a black swan, they're very rare, unexpected even. Black swan, that name or that phrase is also a term used by economists to describe a rare and improbable event in the marketplace. When it comes to the health of the U.S. economy, a black swan almost always has severe consequences. One example, the 2008 financial crisis. This year, the outbreak of COVID-19 and the pandemic and its effects have created another black swan event in our lifetimes. You'll remember back in March and April, that significant drop in the market. We had a huge unemployment. Now, granted, over the last few months, some of that has started to come back, but our economic indicators still are better than they were in the spring, but still looking pretty tough. This black swan has had a big impact on all of our economic situations. So to help deal with that, Congress passed what's called the Coronavirus Aid, Relief, and Economic Security Act, the CARES Act. This was an unbelievably massive piece of legislation to help support the U.S. economy. And it did that for a significant amount of time. The legislation offered sizable and targeted immediate relief to consumers, to small businesses, and provided support to healthcare system, to states and municipalities, and other key elements of the U.S. industry. So we've all heard the headlines, of course, the $1,200 recovery rebates or the stimulus checks, the increased unemployment benefits, and the Paycheck Protection Program. Unfortunately, those have expired. And of course, we are still waiting to see if there's going to be another stimulus package passed, a CARES 2, so to speak. What I'd like to do is dig a little deeper and go over 5 points of the CARES Act that could be relevant to you in your retirement savings. To begin with, we're going to explore the ways the Act could give you flexibility with your retirement plans. Then we'll see the changes that could affect you and your kids relating to student loans. And we'll conclude by looking at how you are in a position to be generous at this time, and this law could actually help. And so with the CARES Act, we have increased flexibility for accessing retirement money if you need to supplement your income due to the COVID-19. You now, under the CARES Act, this year will be able to take distributions for up to $100,000 from the employer retirement plan or IRA, and the 10% penalty for early distribution is waived. That may not hit most of you, but certainly maybe people you know or maybe your children. So the waiver applies to distributions taken between January 1st and December 31st of this year, of 2020. In addition, the 20% withholding requirement that is normally mandatory has been waived. So to be eligible, you must have been impacted by COVID-19. You have to be able to sort of prove that you self-diagnose or self-prove that you were impacted by the disease. The distribution is still taxable, of course, and it can be included in this year's income, which would normally be the case, or you can actually spread it out, that income, over 3 years to help ease the tax burden a bit. And that amount that you may take out for sort of an emergency can be rolled back into the retirement account over 3 years. Second, the law also loosened the qualified plans, IRA, 401k provisions for loans. The loans allow, typically the change now allows loans from qualified plans up to $100,000 or 100% of the vested account balance, along with an additional year for repayment. This may or may not be a better option for some than taking a penalty-free withdrawal from their qualified plan, especially if you're over 59 and a half. But you want to be sure and talk with a financial professional and walk through all of the implications if you think a distribution or a loan may be wise for you given the situation and the impact of COVID-19. Third, the required minimum distributions in 2020 are waived. I'll slow down there for a moment. If you haven't taken your required minimum distributions, your RMDs, they can be waived this year because of the CARES Act. So if you don't need the RMD for income, it may be better to leave it in the account and potentially lower or potentially recover some of those earlier market losses from this year and avoid that taxable event. Or it may be a good year and there's not a lot of time left, but to consider a Roth IRA conversion. Also, let me back up a second. Sorry about that. In terms of RMDs, they not only can waive the RMD, but eligible plans include essentially all of those qualified retirement plans, whether it's 401ks, 403bs, the government 457b plans, and IRAs. It's important to note, though, however, it doesn't apply to defined benefit plans or pensions. The fourth benefit are for those that you know with student loans. The law suspends federally held student loan repayments and the accruing interest, suspends that through September 30th this year. Now, Joe, this is November 17th. Well, by executive order, that was extended to December 31st. And that applies to both student and parent federal loans. So if there are people out there with parent plus loans, it applies to them as well. Of course, any payments that are made during this time will actually help reduce the principal without the interest going up, and you can pay off loans faster. The benefits don't apply to private or non-federal loans. You'd want to be sure and check with the lender if they are offering any type of support during this time. Now, how many taxpayers do you think don't claim realized deductions on their federal tax returns? In other words, they can't do itemized deductions. That's about 9 out of 10. This change means that, or without that change from the CARES Act, which we'll talk about, most people take a standard deduction. So if they're giving charitably, it's going to probably roll into that standard deduction unless you can itemize. And so one change this year is that you can be a little more strategic about your giving, because one change in the CARES Act is you can make a $300 deduction for charitable gifts that will be over and above the standard deduction. You don't necessarily have to have itemized deductions to be able to take this $300 deduction. So you give at least $300 to a qualified charity, and you're going to be able to add that deduction to your tax return, even if you use the standard deduction. It's a big difference from the past where you couldn't For most people, they couldn't get additional deduction for charitable gifts. Now, a second change lifts the limit of how much a donor can deduct in charitable gifts in a single year. It used to be 60% of your adjusted gross income. Under the CARES Act, you now can make charitable contributions up to 100% of your adjusted gross income for this year only, for 2020. So again, that's up from 60% in the past. And those excess contributions can actually be carried over for the next 5 years. Now, there's some caveats, of course. The increased limits apply to cash contributions only. Eligible gifts are limited to public charities and certain foundations, and they don't apply to gifts that are given to donor advised funds or gifts of property or stocks and so forth. It is only cash gifts. So this, I know, is a quick overview, a lot of this information. What I'd like to do is take a moment and see if we do have any questions. Whoops. I'm not going to make you read the disclosures yet. So we don't have any open questions yet. We certainly encourage you that if you do, please feel free to ask those. What we do need to share with you, and I'm going to stop the sharing for just a moment, is that we've got some resources to help you out. One of the things, oh, by the way, it's interesting to know some of the articles that are coming out right now. One was an article I read, was the pandemic's effect on charitable donations. When you think in a time like this that people would have to be cutting back, charitable donations are on the increase, especially, well, here's one according to Charity Navigator through its Giving Basket donation tool. Gift baskets to donations to Feeding America have increased 1,980% over the past year. So charitable giving is still going on. I mentioned some resources. We want to be sure that these are available to you. I found an article. It's from a third-party source from DuPage Foundation. It's on tax-wise charitable giving tips for 2020. I offered this as well at the 12:30 webinar. And what I'll do is everybody that registered, you had to have your email address to register, and I will send that out to you. So just a third-party article that may help. Another interesting note, I just read an article this afternoon that they're actually making progress on the CARES Act 2.0 or CARES Act 2, they're starting to call it. They're looking at even adding more retirement benefits through this CARES Act 2.0. Some of the things that are being looked at, again, this hasn't passed yet. It's in the House Ways and Means Committee, and they have published the aspects of the new act. But things like they want to encourage new employees that would be automatically enrolled into a company's retirement plan. That would you'd have to opt out if you didn't want to be in. In other words, encouraging more and more people to be saving for retirement. Another thing that they're proposing, you remember the RMD, the required minimum distribution age, went from 70 and a half to 72. They're proposing in this new bill to take that to 75. So that could have a big impact on people that for yourself or people you may even know. They're even talking about changes to the savers credit. And again, this is for certain lower income individuals, but to get additional tax breaks if they save for retirement. And one of the other points they're looking at is setting up sort of a clearinghouse for lost retirement accounts, kind of a national database to be able to look for accounts that you may have lost track of. So that article I'm going to send out. If you have interest in this other information, I can give you the URL, the address for the House Ways and Means Committee summary of the CARES Act 2. If that's something you just contact me for that. The third resource that again is complimentary. It's available to anybody that would like to take advantage of it. I'm just calling it the Charitable Giving and Tax Strategy Analysis Meeting. So this is a complimentary, a free meeting, 1 hour to take a look at your charitable giving strategies, QCDs, and the impact of the changes in the laws that may impact your tax strategies. So this would be a meeting with Tim or myself or one of our planners, and we'd be able to review your situation. Again, there's no obligation to it. So something that's available to you. I just want you to know about it. And so what I'm going to do while we're finishing out is I'm going to actually I'm going to launch this poll that says, I'd like to schedule a free charitable giving and tax strategy analysis meeting. And there's 3 options. You pick one of them. Yes, please contact me to schedule. Later, I've got stuff going on right now, or Thanksgiving's coming up. Contact me in a couple of weeks. Or I don't need this particular type of meeting right now. That's fine. These are all fine options. But if you could just take a minute and pick one of those, that might be useful to you. I had a question come in that asked if the RMDs, the waiver of RMDs is also available for inherited IRAs. And yes, it absolutely is. It's not only for your own IRA, but if you inherited an IRA, the same waiver of RMD is still potentially available to you. And so if that's something that would be helpful, that you can certainly take advantage of that. I'm going to give just another couple of moments on the poll, whether you'd like to take advantage of that meeting or not. Also, if you have any other questions, please type those into the chat box, and certainly feel free to reach out to us afterwards if we don't get to your question right now. So I don't see any other questions. I'm going to stop that poll, and just going to get that out of our way. And then what I'd like to do is to do the legal part that I need to do, and that is to share the disclosures. Really, the main parts of this is so that you know that this is for informational purposes only. There's nothing for sale here. This is strictly for your advice, or for your investment advice, and for your information. And that the fact that we're not financial, we're financial professionals, yes, but we're not legal, accounting, or tax professionals. You'd want to consult your attorney or tax professional for those types of advice. And I'd like to sort of wrap this all up with the thought of, first, I want to thank you for your time. I appreciate your participation. And I want to take a moment and think about considering charitable giving strategies, year-end tax strategies. Here's a challenge. Take a minute and think about one thing that you could do differently as a result of what you've heard here. Maybe it's sticking to your planned strategy, following through on that financial plan. It might be something around inspired giving and generosity. To put together planned giving and incorporate that into your financial plan. Maybe it's tax advantage strategies or QCDs. If you haven't done those before, this could be a great year to take a look at the qualified charitable distributions, or those charitable IRA donations. To take a look at estate planning, maybe because of the elimination of those stretch IRAs. Any of these things are certainly topics to think about, but maybe pick one of those that you could do to impact your financial strategy and your financial giving. So I'd just like to take this down. Let me make sure. And I don't have any other questions at this point. Again, feel free to reach out to us. I'd be glad to help you with any of those. I'm very grateful that you attended this evening to this webinar. I want to wish you well, to stay safe, and God bless. And we thank you from Prairie View Wealth Partners, and have a good evening. Goodbye.